Let's stay with the broader market. The Dow is flirting with a 1,000-point drop right now, more than 950 points down. The NASDAQ is down more than 4%. Malcolm Ethridge of CIC Wealth is with us now on some protection plays, perhaps, in tech with all this volatility. I mean, is there any protection, or is there just down less? Malcolm, can you hear me?
I can. Can you hear me?
I can. So what about that protection?
Yeah, I think protection is probably as good as it gets at this point. But the distinction I would make is just that, quality tech names seem to be getting sold off, indiscriminately alongside lesser quality names, at the bottom of the QQQ and in the ARK Innovation ETFs and such, right? I'm talking about names like Microsoft and AMD and NVIDIA. I'm not talking about junk here, right? These companies all have major enterprise clients, long-term deals, and, government contracts stretching into the end of this decade. So there are companies that are getting sold right now that are selling at a decent discount that are worth a look. But that's as good as it gets, I think, if you want the word protection especially in the tech sector.
Yeah, speaking of AMD, it's down almost 6% this morning, but still up more than 4% for a full week if you're looking at that. What message does that send about a company that did so well on earnings, outperforming, and then how quickly yesterday afternoon's rally deteriorated? I mean, for investors who are wondering how much they can trade and how much they have to hold their nose and be in it for the long haul, what message is this market sending?
Yeah, I think, it's two things. One, it's become, if it's not already become, it's becoming a stock picker's market, right? And so we have to focus more on quality names that are returning capital to shareholders, whether that's through buybacks or dividends or some kind of M&A activity. I would be focusing on those sorts of companies that are better quality instead of trying to go dumpster diving here or go on a shopping spree and just buying tech indiscriminately. Because the companies doing those buybacks that I'm talking about, something like $1 trillion is Goldman's estimate of what buyback activity will look like by the end of this year. Those are the companies that the second half of this year will likely end up having a decent little comeback here, and not necessarily because of any fundamentals or any sort of new product offering that's accretive to the bottom line. It's going to be because share buybacks are just attractive to folks who are looking for companies that are returning capital to them in the near term when interest rates are up and everything seems to be selling off. So you guys just got done talking about Amazon as an example. Yeah. Amazon set to buy back something like $10 billion worth of its own shares this year. That's probably enough to make people pile back into the name, at least in the short term, and bring that share price back in the right direction.
Well, not yet, at least, Malcolm. What about the idea of not buying anything at all? It feels like an increasing number of voices on this network say that cash preservation is the name of the game in this market, and maybe today adding fuel to that argument. What do you think? Do you sit on cash when you see this much volatility and so many macro headwinds ahead?
Yeah, that's a tough one. I think for anybody who has the stomach for this kind of volatility, the right kind of temperament to not get overheated and start selling if you bought the NASDAQ today and then suddenly it starts falling another 5 or 10% next week, like it very well could. Today is very much proof of that. If you're the person who has that kind of temperament and maybe a longer term outlook, by all means, start adding to your shopping list and picking out the names you like. But for most people, it's probably not the right time to be going on that shopping spree, having that dry powder on the sideline and waiting for the right opportunity. I think you're going to get more opportunities since we know the Fed is poised to raise rates a couple more times before the year is out.
Malcolm, we saw Shopify do something interesting earlier this week. Its founder and CEO, Toby Lutke, said that he's going to be asking for shareholder approval for a founder share that would essentially give him more voting power. I thought this was so interesting because obviously that company, in terms of its market cap, its value has come down so much. Is this a good thing for investors? Do you think that we will see more of this from CEOs that are also founders, try to protect their position, maybe fend off M&A acquisition or M&A activity?
Yeah, I think unfortunately we will start to hear and see more of these types of activities that smell a little Adam Newman-y in the future, where companies that are concerned that their share prices have gotten whacked enough that folks are starting to look at them and maybe they're on the chopping block. I do think, though, investors should be weary of that kind of activity. I think focusing on companies that had no business coming out in the last couple of years, coming out public in the last couple of years, and they did so anyway because all the SPAC money was there and it was the time to get it. I think you're going to see quite a few more of those types of attempts as we go through the remainder of this year. And I just would caution investors to not go for the okie doke in that situation where, it looks a lot 1999, 2000-y, and you'll start to see more and more private equity tech acquisitions start to happen. That's how we'll know when we scrape the bottom as far as tech valuations are concerned. When companies that had no business going public in the first place start to go back private, we'll have some idea that we're there.
Now, that being said, we are talking about Shopify, which is up more than 4x over the past 5 years, even after this drop, and still a $50 billion company. So are we at risk of getting into a period where investors' short-term jitters could also get in the way of founders and CEOs' long-term strategies? People got so excited about the hype over the last couple of years, maybe they thought that was normal?
Well, I would ask, is it the investing public, the retail investor who got overheated in that sense, or was it the CEO that sort of made, promises that made it sound good, right? CEOs, half their job is coming out and telling a good story. And maybe they're living and dying by that sword where they told such a good story. The expectation was we're going to continue this ride forever. And now that the music has stopped and there's only one chair left, all of a sudden those CEOs are having to go back and recalibrate how they speak to their investors. But in some cases, it could be too late. Yeah,
I think it was a segment of the investing public. I know we tried to keep people sober over here, but it didn't always work. Malcolm, thank you.
Thanks, guys.